If you're a buyer or a seller of real estate and you discovered that the local trade association, real estate association, was over-reporting the number of sales in a month by 28.5%, would you be upset? And if the news media got a hold of the fact that the local association was overrepresenting the selling prices by 28%, I think there'd be an uproar. Why isn't there an uproar when they overrepresent by 28.5% the number of new listings in a month?
And that is what we're going to be talking about on today's episode of Real Estate Chat. I am John DePerez, and I'm here with. And today we're going to be talking about that, the proper name of it, Terminate and Relist, a strategy that is being used by realtors. Why do they use it? Well, I mean, if you're looking at from a marketing perspective, a listing that's sticking on the market, sitting stale, losing interest, there's a lot of different reasons. And in a market where everybody's looking for a competitive edge and competing with potentially other listings, competing with perception of, why has a property been listed so long in the market? What do? Terminate, relist. Now, what we're going to discover here, as per Robert's investigation, and Robert looking into this, and he's going to be sharing how this will have an implication on many different stats and numbers, is what does a terminate relist affect when it is happening, and what will it end up overstating, and what will be the perception as a result of that terminate and relist. So we're going to share our screen here, and we're going to look into first TRREB active inventory.
Okay, what we're going to look at first is the various methods to measure the pace of a market. Let's say you're a buyer, let's say you're a seller, and you want to rely on, is it hot? Is it cool? Is it cold? Is it a good time for me to try and do what I want to do? So one measure is to look at inventory, just straight up, what is the number of competing properties on the market at the last day of any month? And so this chart shows this going back till 08. And then there's a dotted line on there that shows what does the current month, in this case, November, what's the 10-year and the 5-year average for November's, and where are we relative to that? So in this case, at 11/9/10, inventory, total inventory for the month of November is 13%, 10% below the average. Now, each year is different. If you have a hot first half, you may have a slow second half. The November, December, January months are quiet. It's winter. Many people buy before that. So here's one way of looking at what the pace of the market is: inventory.
And before Robert gets on to the next slide, if you like what you see on our channel, if you like seeing these charts, data, and complete, thorough, transparent analysis, make sure you click subscribe. And make sure you leave a comment and tell us what you like the most out of all of our discussions. And if you have any questions, make sure you leave them in the comments. Let's look at the next slide.
Okay, this is taking the inventory number and dividing that number by the number of sales in a given month, in this case, November 22. And you come up with the number of months of inventory that month. So our 11/9 divided by 44 comes out with 2.62 months of inventory in the last month. Now we look at this whole chart and decide whether we're hot, medium, or cold month. And we can see that if we go back to 08, the beginning, that sometimes there's upwards of 9 months of inventory, which either the sales are very low or the number of listings is very high. One way or another, it comes out to very high. And then for we can see the two peaks of the recent market, which are highlighted in yellow. In March of 17, there was 0.66 months. Everything was selling. Less than a month's worth of inventory. And then recently, in December of 21, surprisingly enough, December, which we say is a slow time, it was hot for sales. It was 0.54 months of inventory. And then we went back up to a normal time of year when things happen, and we bounced around in between 2% and 3%. 2% is the long-term average, and 3%, which is the recent high for a number of months of inventory. And we bounce around in between 2 and 3, and 262 is where we are right now. So there's a measure of the pace of the market. Inventory, which is a snapshot on a certain day, divided by total number of sales in a month, which is one number based on however many were calculated up to the 30th or 31st of the month. divided one into the other, and it gives you a fixed and finite number.
And what's going to be interesting here is as Robert picks apart of these numbers, Robert, you mentioned that this gauges the, I guess, the interest in the market or the health or the condition that the market is in. And so would it be fair to say that not only realtors, but of course their clients and, how far it goes, maybe the media, maybe lenders, maybe economists, how much weight do they put on this number, which we'll see later on, can be, not manipulated, but can be misinterpreted if some of the data points are inaccurate?
Well, the thing is, as salespeople, as realtor members, as brokers, we present this information to sellers and make recommendation to them saying, because there is no inventory, because there is lots of inventory, we recommend that you not try and set a new record price with your home, but that you conform tightly with what has just sold, or go for it. There's nothing for sale. If someone wants to buy your place and doesn't go in 2 weeks, you can drop it, put it up there. So that's how it's used. Same thing with buyers. If they're in, like, here's the same thing, but a different fellow in our office, Ron Hott, made this chart, and it shows the same, even though he calls it the new listing ratio, it's the number of months. And so his goes back further, and that's why it's included in 1990, where there's a terrible, terrible, terrible time of nearly 18 months of inventory. So then you go halfway through the chart and you see the same nearly 8 that I had on mine. And then you come down to now, which is just over 2.5. So is it bad? Because you got two components: number of listings. Is there a flood or is there a dearth? And what are the sales? Right now, we say the sales are half of a hot market and about 40% off the 10-year and the 5-year average. So everything is relative. It's not dead where there was 2,000 sales a month. It's not boiling hot where there's 10 or 12,000 sales a month. And inventory is where it was.
And it's pretty interesting that you point this out because, for one's chart going back to that far, you see at what point, like, could it be bad? Could it be worse? Could it be really worse? And, whether it's us as a profession, plus the clients that we work with, plus the general public, there seems to be something known as recency bias, which is we're comparing what we're seeing now to what has occurred recently. But historically, we've seen much higher levels of months of inventory. We've seen much higher levels of inventory in general. And so in the past episodes of Real Estate Chat that you can watch on our channel, Robert and I have gone through all of these different charts and statistics and showing that, based on the context of the situation that's happening now, here's what's affecting the market currently. And so when you're looking at an investigation into the market, don't just take what the general public and the media is saying, oh, this is a bad market, compared to what and what makes it bad. And if you look at it, when we're looking at historically low average inventory available on the market, and when you're looking at historically low sales and new, whether it's sales to new listings ratio is not as high as it was, rather is higher than it normally was when there was no inventory. And when you're looking at numbers such as how much months of inventory is left, you can see that it's fair to say, Robert, that we're in somewhat of a normal market, or at least a market that's decent enough to be able to navigate through and identify correct opportunities to buy and sell it.
Well, without being too much of a, how many angels on the head of a pin, what we look at is for a reason. And the buyer will look at it to say, do I feel justified in paying what I think is too much for this property because there's nothing else to choose from? This one's got 80% of all my dream come true attributes. Should I buy it, even though I am paying $100,000, $20,000, $8,000 more than what I had planned to? Conversely, the seller at another time will say, you know what? This is the first offer I've had in 47 days. And even though it's less than I had hoped, it's about equal with what I grudgingly would have accepted at the outset. And so it's good enough. What is the rest of the market doing? Is it, because I'm just sitting here on my street in my house and I think my house is great, but what kind of a market am I sitting in? So that's how ultimately it's serving buyers and sellers. It's a tool for them to decide, is it worth waiting, or worth acting.
Absolutely. So now let's have a look at this chart where you go into historically what happened to average prices over the years and including the 90s when we first saw it climb up and drop in price.
So if you look sort of in the middle where 1989, that's the annual year 1989 is adjusted up. That's the, okay, sorry, the lower number is what was actually reported. We call it nominal numbers that were reported by the board at that time. And then if you adjust it by the CPI for all those many years, you get a common dollar, $22, so that you can actually compare the prices. So at the time it was $273, and today's money is $552. So yellow marks every single time indicates that at that time there was a central authority deciding that inflation was too high and they're going to cure the inflation by raising interest rates to stop people buying. And real estate is one of the biggest things that suffers. And so the resultant dramatic effect on prices is that prices go down. So what this is meant to be is to look at the high points and say, where am I now? Compared to what am I? So the peak we saw, the yellow is on top of it, a little dot, which represents 2022, even though we're still in that year. There was a peak and we've come down from that peak. And then the next high point in the chart, if we go back, is in 2017, at which point there was a high point in the April, which was higher, but the average was there, fell down and then zoomed up again. And immediately before that, you can see that the inclination of the line, which I characterize as specs, that the market is driven normally by first-time buyers. It's normally driven by the action at the bottom. Whoever buys the $200,000 house, $400,000 house, $500,000 house allows that person to buy a 750, to buy a 950, to buy a 1.75, to buy a 2.25. It's driven from the bottom. When you bring in specs, they are buying houses for different reasons. They're buying with resale in mind, because the resale will happen, be it in 6 months or 6 years or 16 years. But the idea is I'm acquiring this as a better place to put my money than something else. So there's a cycle to the market of who's buying and who's not. Otherwise, there's a lot of information on this chart that we could talk about, but that's not what we're talking about today. What we're talking about today is what was created by the Toronto Real Estate Board. Well, they did a report on it in May, which was published on June the 3rd for the May results. And it's this relist share comparison chart, which for every single district, including the overall, they announce monthly how many new listings were there, the same number that they put on the front page of the Market Watch. And then they declare for the very first time the number of relists, where they've got a computer algorithm that goes through the data and says, is there a situation where the same owner and the same broker put through a new listing during the original listing period during this month? And it pops out that there's a certain number of them. And then the final column is to calculate of that grand total, what percentage was relisted. And so they give the number 25.8. Now, carrying on, it's the same information except year to date. So even though it only started in May, somehow they magically got whatever the total number of listings for the year and the total number of relists and the relist share. Now, an interesting thing about mathematics is normally you calculate a percentage based on the base. And the base in this case would be the net number of listings. And then the repeats would be how many of that same number, that base number, were repeated, and you come up with a calculation. In this case, they took okay, we've got the base number plus the relists, what percentage of the relists of that? So it gives you a lower number. Now, you had to have a number, you had to decide, somebody chose, and that's what they did. So this is the chart that is prepared every month, and I wish it was on the Market Watch, the two numbers of what's the total number of listings, what's the total number of relists, and what's the net number. And so that everyone would see that's a factor this strategy of selling a house that's sort of gone quiet after a couple of weeks. So you want to refresh it. You want to get rid of the information that was previously for sale. You want to get rid of the information that it was at a previous price and it, didn't sell or whatever. What's wrong with it? Just as John just said at the outset. So that's the idea behind it. And I've been tricked by myself saying, oh, look at this new listing in Leaside. Let's run over there. But you could say, oh, you know what? Before I really was paying attention to this area, it had already been for sale 4 times with the same broker who's his brother-in-law, and they worked it down. So the idea of relisting it is a valid strategy. It's just, it goes sort of overboard in a boom turned into quiet market. And
Well, it affects the sales new listings ratio, as you pointed out in our previous discussions with regards to this, because when you affect the sales to new listings ratio, and Robert is the one who educated me about this, when you have more listings, when you're saying that there's more new listings than there actually are, then what happens to the sales new listings ratio? Understated or overstated?
Well, the sales to new listings ratio, which is how many of the sales are within the total number of new listings, because like what's being absorbed and what's coming on. So if you're boosting this too much, then your sales to listing ratio is going to be lower because you're comparing it to a higher number. But if you use the real number, your sales to listing ratio will be higher.
And that's exactly it, right? So part of what's fueling the negativity, and if there's one takeaway to the video, you're going to be listening into it right now. What's fueling the perception of the market? Yes, interest rates are driving affordability down. Prices are going down, and it's being affected as well. Affordability being driven down, meaning it's going to cost a lot of money to be able to afford. Therefore, you're only able to afford less. But if the sales to new listings ratio is also not stated correctly, you're thinking that there's not as many sales to the new listings that are happening, hence the name sales to new listings ratio as it is. So as Robert's pointing out, if there's more new listings being represented than there actually is, then that ratio is not as high, which means there could actually be more sales happening if the new listings number is correct, right? And so that's what you won't hear in the media. You won't hear that, wait a minute, there's actually more sales than we think is happening relative to the number of inventory that's actually being introduced, because the actual amount of inventory being introduced is overstated to begin with because of the duplicates and the triplicates and however many times a listing is terminated and then relisted.
It's very it's small ball for people who aren't in the baseball game, but it's vitally important if you are or if you're watching. And the reason that we don't know, or it's not widely known, is simply because people aren't paying the same kind of attention as I am, as people who keep stats. For example, because of the way the board did, I created my backup chart, which introduces the thing I was mentioning before of what's the percentage of the net number that are relists, and what is the summary of each one per region? Is it the same all over the place? And what it ends up, by using the gross amount and a share rather than what's the percentage, there's a variance of somewhere between 25 and 30% from what's true just by using the wrong number. So again, this is a small ball. If we go to the next chart, we see it shown in a picture. So the blue line is the number of listings that are reported every month, and there's a season to it, just like anything else. And so the red line underneath is when you subtract the number of relists from that blue line, you get another line, which is minus the do-over. So why don't they want to report the do-overs net? Why don't they want to report the ratio between sales and the net number? It's hard to say. One thing that's been put forward every time I've asked is to say, well, this surge of terminates and relists happens in certain market conditions, and then it goes away. And we look back to 2003, and it goes away, and it's an ebb and a flow. And so rather than give a separate market metric to this statistic, we're just going to let it run its course and as soon as I heard him say that, the word transitory jumped into my mind, that they think that because it used to be that way, it's fleeting, it's going to ebb and flow, it's going to go away. The last time somebody used transitory in exactly the same way was the Bank of Canada, who thought that inflation was transitory, and now we have a huge mess because it wasn't transitory. We've got to start paying attention to true facts.
So how do you fix this? How do you put the truth in terms of the stats? I mean, if you were to correct this now,
Yes.
you'd have to go back like since it's begun. But because the terminate and relist strategy is discretionary, there's no telling exactly, do you start that when when there was a market shift and then a massive number of terminate relists happen? Or do you look at, how much activity is reasonable over time of terminate and relist? And then versus what are the outlying, at what point does it become out of the norm?
Okay, well, you think we rehearsed that because you asked, that's the perfect question. Go 2 charts ahead. The next chart is just the Toronto Real Estate Board's representation of the sales to new listing ratio, which is their number divided for new listings divided by their number of sales. And you can see the orangey line, which represents what it's like in every month. However, the key ingredient to this is one of the things that also changes, if we move to the next slide, one of the things that also changes when you terminate and relist a property is the history goes away. The number of days on the market disappears. However, since sometime in 2009, Toronto Real Estate Board has been keeping a separate track of listing days on the market, which means the contract that was alive, it was active, the time of the sale is the listing days on the market. And then they go back with an algorithm and say, was there another listing with the same owner and the same broker within 90 days of the time when this sold? And if they find that there's another one, a duplicate, then they say, okay, this property's total number of days in the market must be included, must be reported. And so they have a statistic based on the phenomenon of terminate and relist that's been reflected in the front of the Market Watch for years, not for millions of years, but for several years, 2019. And why can't they do it for new listings? If it's valid for property days in the market and gives if it's a valid metric, why can't we do it for the same cause in a different way? So I'm puzzled by the answer to that. They say it's going to go away, but why are you reporting days in the market?
And it may not, so it will never, it probably will never go away. And every market repeat.
Well, no, I don't think we have. Yes, the next chart actually shows it.
Sure.
Next chart shows it. Up towards the top, I've got a bracket of net 0% first mortgage rate era, which they dropped the interest rates, in 2012 to stimulate things after the great financial crisis, global financial crisis. And that continued till last March. Now, I've shortened my time down here. I used to have it go back till 2008, but it made everything too small and you couldn't see it. So that's why I put on here 88B. That's my numbering system time. I've time shortened it. So we're in the net zero mortgage era. And then as part of that, we have the terminate and relist area. Like, it's not all the time that you do terminate relist as a listing sales representative, because if the thing sells in 6 days, you don't need to terminate it. It's only when things get soft. But when things get soft, that's when you need the information. So whether we have to go back for 10 years, I don't know. Again, what's good for the property days in the market has got to be good for the net number of listings and the relist as a percentage of net new. So this one is sort of the bottom line on where we are. That because they've only been putting out their statistics since May, I'm only using their statistics. I was trying to figure it out using what percentage of listings that are terminated turn up again on the listing, and there's just no relationship. Some months it's bigger, sometimes it's. So I'm just using their numbers, where you can see the black line on the top starts in for the month of May I guess, okay, I must have my extrapolations down here too, because it was only this year in May when it started official numbers. So pardon me for getting confused. All
I
you
mean,
care about really is what is it like today? And this is the irony of the situation, that if you subtract the number of relists from new listings, you get a far smaller number. And when you divide the number of sales into it, you get a sales to net listing ratio of 68.97%, which is well above, well, is partially above the accepted seller's market territory of anything over 65%. Whereas if you keep the bloated number of all the doers included, and divide by the sales that are arranged, you get 51%, which is just over the buyer's market situation into the neutral. 45% is the magic number that's been decided over time. So instead of it being buyer's market, when it's actually a seller's market, and the 10-year average has been 71%, so that's pretty darn close to
yes.
69%. That's the way it was like all the way through the boom. So the only thing that's different is the number of sales is down, which we already knew that, but the ratio of the sales to the number of listings, which this is also the time of the year when there's the fewest number of listings, is consistent with the seller's market. So
There you
there's
go.
absolutely no reason for someone who has a desirable house to not put their house for sale because the market is slow. The market is not slow. The number of listings is slow, but it is November after all.
And so the new terminology coined here on real estate chat is sales to net new listings
Yes.
ratio, SNNLR, SNLR. So I mean, the point being here is that, and this could be the title of our show, is the fact that it is a seller's market if you crunch these numbers correctly. And so the perception out there that, yes, in spite of the interest rates rising affecting affordability, in spite of inventory hitting in the market, and us, maybe the general public, not feeling that there is a scarcity of listings, partly because of the fact that it's costing more to buy the houses out there. The actual fact is we are still in a seller's market when you're looking at the correct calculations of these figures. And like 68.97%, near 70%, that's a pretty significant difference compared to if you're looking at a more, I guess, diluted number of 51%, considering the fact that the termination, I almost said the wrong word there, but the termination relists are diluting the actual numbers that we should be looking at. And
this,
so
we'll go back to that one again. I'm sorry. This is the reason that's inexplicable to some of the pundits who say, well, how much can you expect prices to drop? And the pundits come back and say, well, it depends on the area. Downtown, in the good neighborhoods that everybody wants to live in, maybe they'll go down nothing. Maybe they'll go down 10%. When you go farther away and to areas where maybe most of the properties were bought a year ago, 2 years ago, 5 years ago by absentee landlords who were hoping to resell that property, maybe those will go back down to the price that the guy paid for them, which might be 20% or 30% less than what it would have been worth in the very peak of the year this year, because those people have no use. They're not living there. They're not user occupiers. They're investors. It's just a commodity. So if they have to sell it, they won't just get their money back. And if they get to have a loss, well, they bought one before, and so this loss will just capital loss against the capital gain that they made before. So they don't care. They don't care. What we're talking about is owner-occupied sellers and owner-occupying buyers. Now, the next chart makes a prediction based on where we were, how far could we go down? And it's the same thing I was just mentioning, that we could go down to where we were in 2020. We could go down to where we were in, let's call it 2018, 2019. We could go down to where we were in 2015. Who knows? But recently things have sort of stabilized. There's nothing to say you couldn't go down to the 2020 level, because that was a big surge. Look at this big surge that took on the top, the top two surges. So what we need is hard information that buyers can decide, what do I need this house for? I need it because I now have 3 kids. My mother's going to come and live with us, and I want to move into a school district I want to move it to a transit district. I want to move to a high rise, whatever it is that they want. I want that. And I can work my way around the financing. That's the realtors, the brokers, the sales representative's job, the registrant's job is to figure out the financing, because we are in the financing business. We're not in the bricks and mortar business. If you can make the payments work for somebody, they'll buy it. And the seller, well, he's got a mind of his own, and he wants a certain price, and he either can get it or he can't. It's time versus money. So where could the price be? But that's an average price. It doesn't account for quality, doesn't account for maybe the people that with the $3 million house are not selling. They're not offering it, but anyone that comes up on their street immediately gets 5 offers on it at $3 million. But it doesn't affect the average numbers because there's so much action at 750.
And that's that's what we're seeing now, especially as we're heading into the December. I mean, we're in the December market. We're going to be heading into January, and fair to say, we'll likely see what pace the spring market 2023 will be like based on what we see after the holidays. January 1st onward, we're going to see what's going to happen as far as inventory hitting the market, as far as how quickly they sell, how many terminates and relists happen there that inflate or deflate rather the sales to new listings ratio. And so, Robert, to conclude our episode today, what's our advice that we want to give? What's your advice you want to give to anybody looking to make a move? And right now they're the holidays. Some of them, some of you watching this have probably listed a home, didn't sell, you didn't get that offer or that price that you wanted, and so you're taking it off the market. And that's going to count towards the termination and relist, by the way. And you may be introducing it into January. Are we going to see, Robert, next month, all of a sudden, a whole bunch of listings hit the market from disappointed sellers who didn't get the price that they want? And will that perpetually drive further downward pressure on price because of the fact that interest rates have gone up or are going up because of the Bank of Canada announcement and other factors? What do you think?
Okay. Always in January, there's a last year's price and a this year's price, because there's nothing for sale on January the 5th, nothing for sale. So every single realtor gets on the phone to his clients and said, look, there's nothing for sale on your street. I know you want to move at the end of school, or to move to the cottage, or to retire to Florida, whatever it is. I know you want to move later on, but I think you'd be better off to put your property for sale early, beat the spring, and get it done. And some people do and some people don't. This year, there's a lot of people that are waiting for a big spring. But the thing is, that's when your huge glut is going to hit. Everybody who's been waiting, they're going to hit in March. The 15th is the perfect one. What I always say is the real estate market is asleep until the kids go back to school, the Saturday after the kids go back to school in January. By February the 15th, we know what kind of a year it's going to be. It's full blast by March the 15th. And you got these 2 different spring breaks that come up, and you got Easter, and who knows what happens after that. This year coming up, if you want to sell your property, do it now. Do it on the 1st of January. Beat the spring glut. If you want to buy a property, look for somebody who has owned the property before 2017, before 2015, before 2005, before 1995. This is a person who you can talk to, because they're going to get a huge amount of built up equity that they're not going to do anything with for 2 or 3 years. This person, you can talk to them about what we called one time before a vendor take back mortgage. They can hold some paper rather than you arranging a mortgage at these higher rates for 3 or 5 years, and that'll get you over the hump until the rates will come back down again. They're still going to be 3%, 4%. They're not going to be any 2% again, because those days are gone. We're going to have 4% inflation, and we're going to have 4% first mortgages on a variable rate, which everybody just gets all this nonsense out of their system. So all you have to do is buy a good house on the best street that's going to have no problems with it. You can live there for 10 years and work out a deal with the owner what he's going to do with the money. He's going to put it in the bank. Work out a financing deal. So it's a great time to buy counter to what everybody thinks. It's a good time to sell because there's going to be a glut. So beat the spring rush if you're a seller.
And on that note, there's your strategy right there. Thank you so much, Robert, for outlining it. If you have any questions about our discussion, I know it was a bit longer and a lot more extensive
It was
today,
a
but
10-minute one, right? It was a Zoom.
so, I mean, this is very important market information to know. And I mean, if you want to simplify things, feel free to leave a comment if you have any questions
Please.
and, you know, ask Robert or myself any questions that you may have. Make sure you click on the subscribe button so that you know when the next video comes out. Make sure you leave us a comment. And if there's any questions, anything you'd like to discuss on Real Estate Chat, anything you'd like Robert and I to talk about, please feel free to do so. And thanks to everybody who's been leaving comments. Definitely, we appreciate the fact that you're sharing your feedback with us, sharing your questions and your comments, and you're letting us know how helpful these videos have been for you. Our mandate here is education and transparency and providing you with the strategy that you need in order for you to make the right move. So thank you so much for joining us, and we'll see you on the next episode of Real Estate Chat. Bye for now.